Companies are judged by what they have, what they don't have, and what they'll be able to get in the future. In accounting, a balance sheet is a list of a company's assets, liabilities, and equity at a certain point in time. Assets represent a company's resources. It's what they own. Liabilities are a company's debts. It's what they owe. And equity, aka shareholders' equity, is the sum of a company's total assets minus total liabilities, or your net worth. Balance sheets group these assets and liabilities together to inform external parties about a company's liquidity, meaning does the company have enough current resources to pay its bills, and long-term solvency, meaning is the company making money and growing. Liquidity refers to liquid assets, aka cash and near cash assets, and the ability of a company to use that to pay off short-term liability. And long-term solvency assesses whether or not a company can pay off their debts and liabilities in the long term. This helps us understand financial flexibility, which is how well a company can pivot when something unexpected happens to their cash flows or assets. The more flexible the company, the less risk of failure, and the less risk of failure, the better chances of getting more funding. However, a company's book value according to a balance sheet usually doesn't equal its market value. One reason for this is that the market undervalues certain assets like land and buildings. And many times those assets are many years old with lower historical costs than today. Another is that a balance sheet doesn't take into account resources that can help a company's future, such as well-credentialed management and new products on the horizon. And finally, a balance sheet relies heavily on estimates rather than specific amounts. One reason for this is that the market undervalues certain assets like land and buildings. And these assets can be many years old but are producing highly valuable products and services compared to the depreciated value of those assets. Another is that a balance sheet doesn't take into account resources that can help a company's future, such as well-credentialed management or newsworthy products on the horizon. And finally, a balance sheet relies heavily on estimates rather than specific amounts. To fully understand a balance sheet, you have to be able to distinguish between the current and the long term when it comes to assets and liabilities. Current assets are anything a company collects within a year of its balance sheet date or within its normal operating cycle, if it lasts more than a year. The length of an operating cycle depends on the industry more so than the company itself. Current assets include cash or cash equivalents, such as treasury bills or money market funds, short-term investments, such as stocks, accounts receivable, which are cash receipts from customers for any goods or services, inventory of the company's goods, and prepaid expenses, which may include rented supplies, office space, or insurance coverage. And then there are long-term assets, which a company won't convert into cash until after their balance sheet date or after their normal operating cycle, whichever is longer. Long-term assets include long-term investments such as real estate, any property, plant, and equipment costs, intangible costs such as copyrights, trademarks, and software used to increase future revenue, goodwill, which is any cost endured by purchasing another company, and other costs such as long-term leases and other long-term prepaid expenses. Just keep in mind that major internal costs such as marketing, advertising, and research and development are not included in a company's assets as they're expensed as incurred. Once you understand current and long-term assets, you can also apply the same methods to current and long-term liabilities, as they usually mirror one another. And once those are all calculated, the two numbers can be compared to figure out a company's equity. Just think, all of that time and hard work over the course of a year, and it all boils down to one simple equation? That's accounting for you.